Hello and welcome to another episode of Cloud9 Fin, where we cover all things credit from issuance to redemption, performing to distress. I'm joined this week by CEO and co-founder of Liquidity Group, Ron Daniel. Ron, how are you today?
Thanks. Great to be here. Wonderful day in New York.
Great. Thanks for joining. We're going to talk kind of all things growth capital, venture debt, tech lending, all that sort of stuff today. I guess a good place to start is at the top level. And I just want to understand a little bit more about what venture debt or tech lending is. So what is it and how does it differ from kind of regular way private credit?
So let me start by defining that what liquidity does is basically a bridge between what is considered to be private credit and venture debt. They are completely different things. What we see today is a lot of private credit activity trying to trickle down into venture debt. It's not particularly successful so far. There's many reasons for that, but as a start, I can say that venture debt is mainly based on lending capital to negative EBITDA company, mostly, which are in their growth stage. And the financing is non-dilutive and based on the fact that they have big investors behind them and a lot of capital to secure the lending. It's not based like normal credit on a real asset and other private credit segment where the underlying asset is really clear, and basically the performance of the company, of the borrower, is what's important. It's mainly based on the fact that the lender believes that the investors in a downside scenario will back the company. That's venture debt. Venture debt originally came to place from banks like Silicon Valley Bank, etc. They try to have a loss leader to basically get the banking activity of companies. So they waited until companies will get to like not mature stages, but like a bit later stages than a pure venture stage, start to get some revenue in most cases, not always, but have a lot of equity pouring into the companies. And once they had this capital in, the bank came and say, hey, why should you use your capital? We will lend you against this capital. But when you think about it, they basically lend them their own capital because they lending capital, but they secure capital against it. So it was not pure private credit move. Private credit, on the other hand, it provides real capital against either asset it can understand or business activity that it can monitor.
Right, interesting. No, that's great. In terms of the lending that you do, or in terms of like venture debt, are there any structures, terms, covenants that are fairly consistent across those types of assets?
It's again great questions. I think what's unique about what we are trying to do is there are covenants everywhere. In all type of lending, there are covenants. But the key is not to put 20 covenants. Because if you put in a loan 20 covenants, no one can really understand the loan. And we see a lot of private credit big firms, you get their agreement, it's a list of 50 covenants because they can't identify the right junctions. What we're trying to do, and I think the future of private credit and also venture debt, is to understand where the junction that things can break. Okay, if something can break, this is what you need to monitor. You don't need to monitor everything. So if you can monitor in real time, you know, maybe the customer acquisition cost when it's go beyond a certain threshold, maybe cash flow, maybe runway, maybe other thing, you know. But you need to identify the exact parameters in each client that can break the execution trend. So we're trying to do 2 to 3 covenants.
Right, interesting. Do you have typical covenants that always come up in the same deals, or is it idiosyncratic based on the deal that you're doing?
We're very vertical agnostic inside what we do. So every company is different. When you look into a recurring revenue company, and there's multiple models around a recurring revenue, and e-commerce companies, different tech platforms, they all have different business models and different places that things can break. So it's a very case-by-case type of covenant.
No, great. We've talked a little bit about tech lending and about tech being the major sector. I guess I want to dig down a little bit because tech is the obvious sector when you think of venture debt, at least. I know you're doing a little bit of tech lending or mostly tech lending, but are there other sectors that this type of lending makes sense for or that could expand into?
So I think that the credit market is standing in front of significant revolution. Okay? And what do I mean? If you look at credit in the entire history of human, it hasn't been changed much. At the end of the day, it was, here is my asset. This is the value, and I want you to lend me money against the value of this asset. And I can say, hey, your asset worth $100, I will lend you 50 against it because I need extra safety. Or I can lend you 80, or I can lend you 120 against this asset. But the value of the asset was always very clear, okay? Or it was a clear range. I'm owning a building. The building in a bad day worth 50 million, in a good day worth 100 million. It doesn't worth 0 or 1 billion, right? And what we see today in the market, that most of the borrowers are actually companies that are growing fast, but the assets they hold are very volatile and fragile. Like tech company, doesn't matter what the IP is, it's still an idea. It's still cash flow business. It's still most of the value is in the future and not in the past. So the ability to understand what is the LTV or how to price the risk is almost impossible if you don't understand the company like really in granular way and can monitor the risk change over time. Because this company today can worth, and we see it a lot of time, a lot of tech companies worth $40 billion, and the day after they're worth 20, and some companies worth 10 billion, and 2 years later they don't even exist. So the understanding of volatile asset become the future of risk, and the future of understanding risk is the future of private credit. Now, banks don't want to be in this game. That's why they stuck in venture lending. But how do they bypass their ability? They're using outlets like us and others to bridge the gap of the risk that they don't want to take. But in order to build this bridge, you need to understand the risk. If you confront a risk which is triple B, but you experience as minus B, you will underserve the market. If you see a minus B and you serve it as triple B, you will overservice the market and you end up with a lot of defaults. So you really need a real-time understanding of how the risk develops at any given moment through the loan cycle. It's a different type of lending. You don't just do diligence, give the money and hope. You have to be active throughout the entire loan cycle.
No, that makes sense. And are there any particular types of tech that I guess carry less risk within this market or more risk, like or on either ends of the extreme there?
I wouldn't point specific verticals, but specific methodologies. Okay, I think that the most important thing in the companies that we are lending into is that the ability to control and monitor and manage the growth. You want management that understand the risk it takes. Okay, many times in tech that's not the case. Okay, so at the end of the day, it's the human factor, like understanding what risk you take. Be able to control your own company budget, runway, expansion, those type of things.
So it sounds like you're underwriting the entrepreneur more than you're underwriting the software a lot of the time.
No, absolutely not. But it's always the missing element, which is also important, right? At the end of the day, companies has in the base, they have all the companies has the very basic things. It's called unit economic, right? If it cost me $1 to generate $1.50, it's a good start of a business, right? But how many dollars can I generate this way? So if I can only generate 100 and I already at 90, there's not a lot of potential left on the bone. But if I'm at 90, but there are 900, there's still a long way to go, right? And so you have to monitor how the unit economic evolve over time, how much it costs to buy a new customer, how much you generate from it, and what time frame, how stable this is, how scalable this is. And the only way to do it is to monitor the company as it goes. Because if you identify change in this parameter, everything else doesn't matter. Because if you sell $1 for if you buy for $1.99, you can have $1 billion business in a day, but it's not the business you want to be in, right? So, and many businesses are like that, and they are not even aware to that. What we do, we unstrip them to an extent that we understand the granular data and how it evolves.
No, great. And then you obviously loan against that, which is
yes,
the business. I want to go higher level here and just talk a bit about the macro environment, because we've talked a little bit about how you kind of underwrite, but the month that we're having this conversation in April 2025, there is a lot going on in the political sphere. There's a lot going on in the macro environment. So let's split those into two parts. The tariffs have dominated conversations that I've had with direct lenders across all factors of the market, from the upper middle market to the core and lower middle market to the ventures and tech space. How have they affected your business? How are you navigating that sort of in real time and managing this unprecedented situation yet again?
Yeah, so I don't think this situation is unprecedented. I'll start with that. I think that we are in April 2025. And if you ask me this question in 2021, you probably ask a similar question because of different reason. And in 2023, when the Ukraine war started, you would ask it the same question from different reasons. So there are always a political reason that something is in a crisis. And I think it's just a natural circle of life. What we see the market tilting, in our point of view, it's at the end of the day, when you sum up everything, is either market tilting toward equity or credit. Equity, credit. And macro event and political event and geopolitical event and war and all this stuff, at the end of the day, in my shallow point of view, when I take it to my business, end up with more demand for equity or more demand for credit. And this is a constant circle that keeps changing, okay? It keeps changing not just because the macro environment, also because interest rate, etc., but they are also influenced by macro environment. So I don't think the situation right now is very different than it was like 2 years ago or 4 years ago. And we see this cycle every 2 years or 3 years. Now we call it Trump. Before that, we call it Ukraine war, Ukraine-Russia war. Before that, we call it COVID, and so on and so on. But there's always something in the market that make equity investor freeze. Why they freeze? Because something happens and they don't want to price things in the market. People need to understand there's a lot of money in the market. People don't want to put it in a specific price because they don't know what Trump will tweet tomorrow, right? And they think long run for long run investment, which is like, I think it's a problem, but this is how people have been trained to think. And that's trigger a freeze in the equity. The freeze in the equity is serving our lending business, right? Because we have a lot of demand. Last quarter, we landed over almost $500 million of fresh capital into the market, which for us, it's a lot of money. It was a break record quarter in a single quarter. But next month it can be different, and next year it's eventually a cycle of credit versus equity. And for a short period of time, they are equal, but most of the time it's the market tilting this way or another.
And that makes a lot of sense. And I want to come back to the point you've made about the record quarter in a second, but I guess quickly on the particular tariff situation and the political uncertainty just now, is it having any effect on portfolio companies that you made investments in like a couple of years ago? Like, are you exposed in any way like a regular corporate lender might be with, say, manufacturing or something, or is it not really affecting your portfolio?
It's not really affecting the portfolio because it's a zero-sum game. We are a global player. We invest in over 26 countries. So balance itself. Diversification is important. When you diverse, you are not influenced by this type of event.
Okay, no, perfect. And then to your point on the record quarter, like, the one thing I wanted to come back to was, away from the political situation, the general macroeconomic situation for regular way private credit or corporate credit specifically has not been great, right? We've not seen a lot of M&A activity and it's been down. And as a result, a lot of activity in the regular way private credit direct lending market has been driven by incrementals or refinancings or repricings and less so by LBOs, essentially. Is that kind of dynamic still in the tech lending venture debt space, or is that governed by a completely different?
So it's exactly the same. There's no difference. It's exactly the same. And again, it's the same pattern of equity versus, when you talk M&A, it's again equity. When people don't want to price element in the market, they go to credit. When they want to price it, they go to equity, and so on and so on.
No, makes sense. I guess quickly, couple more things. I'd be remiss, because I know that you guys are kind of constantly fundraising or looking. We've spoken before, I think, about everyone's always looking for capital all the time. One of the things that we wrote last year that I think is true is that direct lending, regular way, like core middle market, upper middle market direct lending allocations have stagnated because LPs mostly have filled those allocations already, and that part of the private credit market is understood. What is less understood, and I think the reason why we're doing this podcast, is venture debt, tech lending, growth lending, specialty finance, litigation finance, that sort of thing. So I'd be curious what your pitch to LPs would be for your brand of tech lending or venture debt more broadly over some of those other niches that might be attracting LP interest in the next few months or years.
Sure. So I think that at the end of the day, when you look at the private credit market, but even broadly on the credit market in general. At the end of the day, on the traditional vertical, real estate, ABS, all this type of lending, it's a price competition. And the market is already a really, really red ocean full with blood. So the yield is not so good. So you have low yield market, super sensitive to macro movement in a very volatile environment. So investors are seeking for something that at least if it's volatile, at least have a bit space, a little premium on the margin, right? And when you look at the market like tech lending, where true, the underlying asset is not clear the value, but if you know how to monitor and if you have the right expert, he can monitor the value and monitor the risk and manage the risk. If you find a GP that can manage the risk properly, then it's not a price competition anymore. So you can generate premium on the same capital with about the same risk level. And so it's less volatile when the macro environment changes because you still have a lot of place to move inside in the margin. I think that's the benefit of tech lending. Yeah.
No, great. And I always like to ask this at the end of conversations, but I'm going to ask you to get your crystal ball out a little bit and just give me 2 or 3 predictions for your space, for the venture debt space in the next year or so as we head into 2026 and beyond. What's going to happen next in tech lending and venture debt?
So I think interest rates relatively stable, so people used to be very sensitive around what is the interest rate? But now people understand money has cost, it cannot be 0, it cannot be 10, but the base has to be somewhere in the middle. And it's pretty stable the last few months. I believe it's going to stay this way. At least this element is going to be out of whether the market's growing or not. And I think it's good it's out because it's obvious that there's a price for capital. Okay, it has to be obvious. And in this environment, the market will continue to grow constantly, but it's just normal evolution. There's not going to be huge gaps. It's going to be a constant growth. It's not going to be exponential. It's going to be linear. I think what we see is we're going to see exponential growth of players that can be more effective in a linear growth market. And how do you become more effective? You introduce a better technology, better service, better product, better understanding of risk. So we're going to see a lot of the old traditional dinosaur of the market. I think not shrinking, but stop growing. And we see growth of new players which are more techy, tech savvy, and more on top of the risk element.
Who'd have thought that tech lending would be benefited by the tech itself? With that food for thought at the end of the episode, that's it for another episode of Cloud9 Fin. I've been your host, Peter Benson. I'd like to thank Ron again for his time. Thank you, Ron.
Thank you, Peter, very much.
If you guys have enjoyed this podcast and want to hear more, please give us a follow on whichever podcast platform of choice you listen to. Give us a rating and review, and tune in next time for more discussions on all things credit. Thanks.